Hello, I'm Gregory Langham. Today I will be giving you a ratio analysis on three companies. The three companies I'm giving you a ratio analysis on is Exxon, eBay, and Apple. First one, I also will be giving you three questions on it. Which one should I invest a short-term loan into? Which one should I invest a long-term loan into? And which one would I decide to buy 50% of? First one I'll be starting with is ExxonMobil. ExxonMobil is a very profitable company, but we're going to look at it a little closer with the ratios because short-term loans are a little different than other kind of loans. The three ratios I decided to use to figure this out is the cash ratio, the current ratio, and the quick ratio. The cash ratio averages how much cash they usually have on hand to paying off their liabilities. The current is all their assets put together to pay off their liabilities, and then the quick would be minus their inventory. Looking at this, it seems like in 2012, as you can see in the graph, they were going up. As continuing forth, they started to go down, which isn't always a bad thing, but it could be. The next company is eBay. I did the exact same ratio analysis over them. I compared it over a couple of years, and I made a graph. The graph's showing like it's going down. Let's go back one. All right. For the other short-term loan side, look into Apple. Apple's a very profitable company, but after I broke it down, I decided, wow, little things going, it looks like the ratios are all going down by a lot. It looks like the average in general went down. After a long decisions into analysis and the whole 9 yards, I decided to look into company eBay. Let's go back to eBay. As you can see, eBay is going down, but if you look at their cash ratio, current ratio, and quick ratio, you can see that the average is actually pretty stable and it's pretty high compared to the other companies. In this case, you would probably want to be side with them with a short-term loan over the other loans, just because it would make sense because you'd be they take out less risk, they can pay back companies faster, so you wouldn't get your money back, so you get your money back faster. The next question I'll be covering would be a long-term loan. First company I started with was eBay. To solve a long-term loan, I decided to use the two ratios, equity multiplier and time interest earned. After looking at most of them, even though eBay, I couldn't find the 2010 one, it wasn't on the Bloomberg lag, which I got all the information from. Still though, it looks like their equity multiplier and their time interest earned is decent. The time interest earned has dropped a lot, which is good. ExxonMobil, long-term loan. I did the same ratio with that as well. As you can see in 2013, they had an extremely high time interest earned. I took that out of the ratio because that seems to be a little out of the norm, and I ended up combining just the other ones to find out where that ratio would be, and that's how I pulled it into it. And then there's also Apple. Apple didn't have time interest earned for the first 4 years, which isn't abnormal because their earnings just could have been negative for their stock. Their equity multiplier seemed pretty high. After doing some quick analysis and everything like that, I ended up figuring out it was Apple. They had a lower equity multiplier than the others. The time interest earned is higher, which shows that they are capable of handling more debt. And in a long-term loan, that's what I'm really looking for. I want to be able to make sure I can give out the big amount of money and I can also get it back. Where Apple looks like they are capable of handling it. When we go back to Apple, we can see here that even though they're missing the last 4 years, the current year they have almost extremely little debt, and they have a really high equity multiplier, which means they can pay it back. Oh, I'm sorry, extremely low equity multiplier. If we go back to ExxonMobil, you can see that the average of time interest earned, it looks like they take out loans normally, so that lowers the chance. None of these companies are a bad choice for any of the three options. They obviously all make tons of money. I'm looking for the best option. If you look back at eBay, you can see eBay is kind of consistent and working out and it's working good. It's just not as high as I'm looking for. The last question is which company I would like to buy 50% of. The first company I started with was Exxon. I went over a lot of, because in decision to buy 50% is extremely risky. I had to go over a lot of ratios. The ratios I ended up going over were profit margin, total asset turnover, equity multiplier. return on equity, return on asset, and price earning ratio. Looking through this, you can see that the profit margin for Exxon is decently stable. You can see that the total asset turnover is pretty high for most companies. You can also see that the equity multiplier is consistent. The return on equity is about the same all the way through, and the return on assets is the same all the way through. You can see they had a spike in 2012, and they had kind of lowered from there on out. The price earning, though, has gone up, which is a very good key to investing, because there you go. eBay is a pretty decent company. They definitely make a good profit margin. It looks like it's kind of sporadic. 2012 they had a high one, and then 2014. The total asset turnover seems extremely consistent. It's low, but then again, they don't deal with a lot of assets. Equity multiplier. The equity multiplier is low, which is good because then they can, it shows that they can afford more things, more risk, more loans, etc. The return on equity is extremely consistent, but at the very end, it dropped. That is a key sign. That's not a good idea. That's kind of bad for buying 50% of. It looks like they don't have the equity to continue forward. The return on assets also dropped at the very end. That's not good. Also, the price and earnings has stayed consistent, which is good. Apple is a very profitable company, and they stayed very consistent. The total asset turnover is dropped over the years, but it hasn't dropped enough to threaten anything. The equity multiplier shows that they can take on debt, and the return on equity is a key factor to this, and it's extremely high. The return on assets is also high, so you know they're making the money. Price to earnings ratio. You can see that their stocks are going up in price, which is very good for investing. After all the analysis, I ended up deciding it would be Apple. They have a lower profit margin, yes. You can compare it to eBay with the 162 and the 79. That's the average over with. But I mean, consistency is always good, especially when a company can continually pay. When they get the return on the equity, when they get the return on their assets, you know they're going to make the money, they can take the risk, and they can still pay shareholders. And that's it.